Let's continue on session one with chapter one, which is an overview of financial management and the financial environment. The little comic strip here is we have an investment and retirement planning session where you have a consultant working with a client. And he says, you have to spend money to make money. So I've bought myself a cabin cruiser, a luxury sports car, and a giant screen plasma TV. Well, that's not exactly what we mean when we talk about investment, but being wise with your money is definitely something we want to become proficient in. The learning objectives for chapter one are to understand the objectives of the firm, and that is to create value for the shareholders and employees through increasing the future cash flows. Second is look at different organizational forms. This is a fairly technical topic, which is important for you guys to understand, related to the differences between proprietorships, partnerships, and corporations. Third are looking at our markets, the securities that make up the markets, how the markets behave, and what are the institutions that participate and create the flow of funds in the marketplaces. And fourth is to look briefly at the subprime mortgage meltdown and the financial crisis of 2008. That occurred recently, and it's still having its ripple effects on the recovery of markets and also our thinking about how securitization works and how financial markets can sometimes get out of control. So let's start with the 5-minute MBA. Probably going to do it in less than 5 minutes. The objectives for the company are first to create value for the customers, because if you don't do that, you'll have no customers and you'll have no business. And secondarily, then to create profits and cash flow by our ability to create products and services that are demanded in the marketplace. The key attributes you'll find in successful companies are skilled people. Without skilled people, you probably won't get very far. Second is relationship with stakeholders. Stakeholders are your customers, your suppliers, your communities, regulators, influencers. These are the stakeholders in the business, broader than simply your value chain. And then your funding, what type of funding you have, the support from your shareholders, support from your debt and bondholder communities. A firm's value is determined largely based on its future free cash flows. That's a fundamental aspect of how finance is built. The idea is that the value today is based on the value that we can expect going into the future. A lot of people think that the value of a company is based on its past. Oh, if the company has been worth $100 in the past per share, it must be worth $100 in the future. Well, that's not true whatsoever. What makes that $100 company in the past worth $100 in the future is that it continues to do well and that the expectations are for continuation of good profit. In a formula basis, the free cash flow equals sales revenues minus the operating costs minus the operating taxes, namely those are taxes on operating income, minus required investments to maintain the business. And the number itself that's left over is what's available to distribute to the investors, stockholders, and creditors. So what can managers do to impact the cash flows? The amount of expected cash flows, the more you have cash flows, the better. The timing of the cash flows, the sooner the better, because money today is worth more than money 10 years from now. And the risk of cash flows. The less risk, the higher the value of that prospective flow. For example, if you buy a lotto ticket, it might be worth $10 million, but is more likely to be worth zero. So there's a high degree of risk when you buy a lotto ticket. That's what we're looking at. These three aspects, the cash flows themselves, the timing of the cash flows, and the risk of those cash flows occurring are the three main determinants of the cash flow and valuation. Another term that you will use quite a bit in finance is the weighted average cost of capital, otherwise called WACC. Each word means something in that phrase. WACC being weighted average. So the weighted average means that depending on where is your source of capital, it'd be weighted accordingly. If a company is 90% financed by debt and only 10% by equity, well, the cost of the capital for the debt is going to be weighed quite a bit heavier than the requirement of return for the equity holder, which is only 10%. So the weighted average cost of capital would be heavily toward the debt side. Now, what if the opposite were the case? If it's 10% debt and 90% equity, well, then the weighted average cost of capital should be higher because there's more equity and they demand higher return than a lender. So weighted average cost of capital shows that for a given company and its composition of debt and equity sources, and also the required return from their providers of debt and equity, you will determine their cost. So that's the WACC. It's affected by the capital structure, this percentage of debt versus equity. Second is the cost of that capital. In the case of debt, that's the interest rate. In the case of equity, it's the required return that the shareholders have for investing in you in the first place. And again, the risk. The higher the risk, the lower the value, or the higher the required return. So we'll do a sample calculation of weighted average cost of capital. The given information in our assumptions will be the bondholders require a rate of return of 10%. That's an interest rate on the bonds. The effective income tax rate is 35%. Shareholders require an equity rate of return of 20%, and the firm is financed 60-40, 60% debt, 40% equity. So what is the WACC? All right, so we'll carry this into a spreadsheet just to use a tool that hopefully you'll become very familiar with. We'll start with the cost of debt, and then we'll have cost of equity. The amounts were 10% and 20%. So this is the required return, and let's format it. So just shade it and hit the percent. And then we have a tax rate of 35%. The net, if you will, here would be plus 10% times 1 minus the tax rate. We'll use that quite a bit, the 1 minus tax rate. And there is no adjustment necessary for equity. So now we have the net costs, and then we need the weights. And we knew this is 60%, 60% debt, 40% equity. The amounts, convert all these to percentages also. So let's walk through this calculation. 10% times 1 minus 35% is 6.5% is our net cost of debt. It's lower because we have a tax shield. Cost of equity is 20%. Ratios are 60-40. 60% of 6.5 is 3.9%. 40% of 20 is 8%. And this number is our answer. The weighted average cost of capital equals 11.9%. All right, so let's get back to our example. So if we use the free cash flows as the basis of valuation, then we can use the weighted average cost of capital for each of those cash flows. And if we add up every single cash flow from the next cash flow we're going to receive all the way to the last, or infinity, and we discount them back at using the WACC, we will get today's present value, or what we call the intrinsic value of that investment. This relationship here, value equals the present value of all future cash, is the basic valuation approach in finance. And the breakout using free cash flows is you take free cash flow for time 1, which is a year from today, and then you divide it by 1 plus the weighted average cost of capital. The one we just did was 11.9%, to the first power, because it's 1 year out. Then you take the cash flow that's 2 years out, FCF2, and then divide by 1 plus WACC raised to the second power, because you're waiting 1 extra year to get your money. So the longer you wait to get your money, the larger and larger that denominator becomes. And that's why we call it discounting the cash flows. All right, so that would be the generic formula for a free cash flow based method of valuation. A depiction of how this looks graphically is that the centerpiece here in blue shows what I was describing. Above it, we show how we derive the free cash flow. Sales minus operating costs and taxes minus required investments in operating capital is free cash flow. So that's how we get the numerator. The denominator, and this is something we'll learn later on in this course, and you'll also work a bit with it next time you take finance in corporate finance, is looking at the elements that give rise to your cost of capital, which is this mixing of cost of equity and debt which has a measure of how the market perceives your risk as a company and also the amount of risk that you're undertaking. So all those are the components that feed into the two types of information we need, the free cash flow and the weighted average cost. Let's try to do a valuation. We have cash flows of $100 million, 150 and 250. And at the end of year 3, we sell the company for $1 billion. WACC is 10%. The debt is $300 million. What's the value of the company? And what's the equity value to shareholders? So again, let's move out into Excel. 100, 150, and the sale is $1 billion, which is a thousand millions. The reason I put it there is this is years. These are FCFs, and this is the sales proceeds, and this is total. That equals that plus that. Copy, shift, enter. The WACC is 0.1. Now the factor, again, is plus, open parens, 1 plus the WACC. Let's lock that down with an F4. Close parens, caret is the power to the power of, and power of 1 for year 1. Okay, so let me go through that one again slowly. 1 plus the WACC, which is absolute reference, $B, $7, close parens, raised to the power of C3, which is the first power. By using references, we can now copy this formula. That's why we do it this way, rather than hard coding numbers. So copy, over, and now we have the right factors. So now we can do the PVs, which is the FCF divided by the WACC. So we have these three cash flows, and the sum of those three is enterprise value, and then less debt. Debt, as we've seen, is 300 million. So that's equity value is the billion minus 300. In this case, this company with cash flows of 150, 250, and selling it for $1 billion at year 3 with a WACC of 10% and debt of 300. The value of the overall company to all providers of capital is 1.1 billion. The value to the shareholders is $854 million. So this is a very simple example of something you'll see quite a bit in finance, which is the valuation based on future cash flows as discounted by a cost. Next, we're going to look at a slightly different angle, which is some complexities in running a business. And this little graphic here shows what is at play. Is that if you're the owner of the company, then your interests are aligned with yourself. In other words, you want to make money because it's your business. However, once it gets a little more complicated, namely past one person, it gets complicated in that you hire an employee, and the employee has two motivations. They want to do a good job, but they also want to make money. If the way for an employee to make money is at odds with what's best interest of the company, then we have what we call the principal agent problem, or alternatively called an agency problem, where the agent, the employee, has more incentive to do something for his or her self-interest rather than the interests of the company. And the most typical example of this is a sales commission to a salesperson. If a person is paid, let's say, 20% on the sale of a product, and let's say that the product costs $1,000. If they sell it for $1,000, they get 20% or $200. But what if the customer says, oh, I don't want to pay $1,000. I want to pay $500. Then the salesperson says, sure, I'll sell it to you for $500, because the salesperson can still get a sale, get 20% of 500, and make $100. Now, what's the problem? The problem is if you're the owner of the company, you may be losing money if you sell that product for 500 when the list price is 1,000. So there we have a principal agent problem where the agent, the salesperson, is now given incentive to act in his or her self-interest, which is now at odds with the incentive or the interest of the owner. Now, at a slightly higher level, at corporate governance and board of directors, we have similar issues. And there we have this idea of fiduciary duty. Fiduciary duty is a legal term that means that if the shareholders elect a board of directors, every member of that board has a fiduciary duty to act on behalf of all the shareholders, not his or her personal interests. And you say, well, isn't that the same? Well, no, not at all. If the board has perks and compensation and stock options and junkets to faraway exotic places, and then now somebody comes and wants to buy the company at a very favorable price, the director might think twice. They might say, well, we're going to sell the company for a lot of money. Our shareholders would be happy. That would be fine. However, what if they say, well, we can sell the company, we make a little bit of money, but I lose my board fees, I lose my stock options, I lose my junkets and all my perks. Forget it, we'll not sell. So that's a breach of fiduciary duty, where a board member is looking out for his or her interests instead of shareholders. So governance is how companies look at how do we govern or make rules in the company such that the best outcomes are possible. And this is a pretty tricky thing. And good design, good hiring, good practices, good culture, all these things kind of counter the natural human tendency for self-interest.